Hello viewers, welcome to another episode on the channel. It's nice to see you all today. Hope you all are having a good time. Before I proceed, I just want to say a big thank you to the regular viewers on this channel. I realize that you could be spending your precious time watching or doing something else, but you are here. And for this, I'm grateful. I'm also grateful to you if you have subscribed and hit that notification bell. Hopefully this means you're getting your time's worth from the content being uploaded on this channel. If you haven't done so already, please do consider hitting that subscribe button, and you might as well hit the notification bell while you're at it so that you're made aware of new videos as soon as they go live on the channel. We do our best to find out investment strategies that are worth your consideration on this channel. You can also follow us on the social media links in the description below. In today's episode, we will take you on a journey from being a simple investor who buys and holds shares to being a knowledgeable investor that understands what can be done to get some extra value from your investments. We will look at the following: buying shares at market value, limit order purchases, cash secured puts, covered calls, combining leaps and Pullman covered calls to generate extra value from your investments. And if you watch till the end, we will also show you how you could go wrong with the Pullman covered calls and also how you can manage the risks associated with this options trading strategy. Are you ready? All right, let's get it. In this video, we will use Microsoft, which is ticker symbol MSFT, to explain the different concepts that we're going to talk about in this episode. So assuming you're just getting into investing, you could decide that you're a big user of Microsoft products, you've heard about them, you love Bill Gates, and you think that Microsoft is a good company for you to invest in. There's nothing wrong with that. As you will see today, Microsoft is trading at about $250 mark, which means that you could just go ahead and make what is called a market order for Microsoft, which means that you're going to buy Microsoft at the prevailing market rate. This is a good strategy for people who just want to buy an asset and hold for the long period, and they don't really care about what price they get into buying that asset. They're just going to buy it. So for example, with yourself, you're happy to own Microsoft for the long term. And as you can see here, Microsoft pays dividend every quarter, which means that your ownership of Microsoft shares will almost guarantee you a quarterly income payout for every share that you own with Microsoft. And if you're the type that doesn't have $250 to start with, you can look at going into platforms like eToro and Trading 212. We'll leave the links in the description. And those platforms allow you to buy what are called fractional shares, which is assuming you have only $25 to invest, you can buy 1/10 of a share of Microsoft. And that means that when Microsoft makes their dividend payout, you will receive 1/10 of the dividend, which is correspondent to the total number of shares that you have purchased. So here I am on Trading 212. I'm looking to execute what is called a limit order. I'm buying one share of Microsoft, and I have stipulated that I want to pay $240. So this is a limit order. I can set the expiration of this limit order to be till the end of the trading day, or what is called GTC, which is good until cancelled. In other words, this transaction request will stay pending until such a time that either the price of Microsoft drops to that $240 level or I cancel the transaction. So what this means is that Trading 212 will block $240 for one share of Microsoft until such a time that Microsoft drops to that price, and then it will execute the transaction. The challenge with this approach is if the price of Microsoft never drops to that level, my transaction will be pending until I cancel it. This means that if you're still waiting for Microsoft to drop in price, but it keeps rising and they declare dividend, like they always do every quarter as we've seen, you will miss the opportunity for that capital appreciation. So to illustrate, if Microsoft is trading at 251 today and you've put in an order for 240 and tomorrow Microsoft jumps in value to 260, you have missed that opportunity to buy Microsoft at 251 and possibly sell it at 260. That is one consideration. A second consideration is that if the price of Microsoft drops to $240, there's a chance that it could drop lower than $240, which means that even though you've bought Microsoft at the price you want, you are probably going to see the value of your shares drop lower than 241, and hopefully at some point it starts to rise again. This is what a limit order is all about. A third option to your investment strategy is what is called the cash secured put. What are cash secured puts? Well, this is an option that allows you to be able to buy your shares at the desired price, but the good news is you get compensation for committing to buy those shares at your desired price. So again, if we go back to the Microsoft example and we're on tastytrade now, we can see here that Microsoft is trading at the $250 mark, but you want to buy Microsoft at $240. And so what you can do is you can sell a cash secured put. And in this instance, we're selling a cash secured put options contract that will expire on the 24th of March 2023. And for agreeing to enter into this contract, we will receive a credit of $300 less fees. But what it means is we need to front up $24,000, which is $240 times 100 units. Now, what are the possible scenarios? If by or before March 24, 2023, the price of Microsoft drops below the $240 mark, we, the person selling the cash secured put, have to buy Microsoft at the $240 mark. If, however, the value of Microsoft stays above the $240 mark by the end of play on March 24, 2023, the put options contract will expire worthless. The $24,000 that we put up will be released back to us, and we get to pocket the $300 premium that we were paid at the beginning of this contract for agreeing to buy Microsoft. So you can see that this is better than a limit order where your funds are just blocked. There's no guarantee that you will get to buy the shares at that price and you miss any potential upside. In this case, you are actually being compensated for missing any potential upside, and you're also getting a discounted value, and you're being paid as well to buy the shares at that discounted value. So what happens if come the 24th of March 2023, the price of Microsoft drops and you get assigned to buy Microsoft at $240? Now you own 100 units of Microsoft that you've paid $24,000 for. What you can then do is immediately sell what is called a covered call. And so let's say the price of the covered calls stayed the same. You can go a bit further down into the future, and let's say you want to sell Microsoft at $245. Now, it's not likely that this prices you're seeing here will be what will be available from the 24th of March, but let's just play along. So assuming that you now own 100 units of Microsoft that you bought at $240, you can then commit to selling Microsoft at $245. And to do so, all you need to do is to sell what is called a covered call. And so with the covered call, because Microsoft covered call for $245 that is expiring on the 6th of April is trading at $12.55, you could potentially receive $1,250 because you're agreeing to sell Microsoft at that $245 mark. So what are the two outcomes from selling this covered call? Come the 6th of April 2023, above the $245 mark, you will get assigned, which means you have to sell your Microsoft shares at $245 per share, and you will get to pocket this premium. If, however, Microsoft is trading below the $245 mark, you still get to keep your premium, but your 100 units of shares are returned back to you, and you can sell another covered call for an expiration date that will come at a later time. Right, let's do a quick, simple back of the envelope calculation on the return that could come from selling the covered call on Microsoft. Remember, you paid $24,000 to buy Microsoft shares and you received $1,250 for selling the covered call. This translates to a 5.21% premium for selling those covered calls, and this is just for less than a month for executing those trades. This is not to take into consideration the appreciation that comes if, for example, you got assigned whereby you bought the shares at $24,000 and because you're selling at $245, you're then selling at $24,500. No, we're just looking at the baseline scenario. You can imagine that getting 5.21% in less than a month beats getting 1.08% returns on investment from just buying and holding Microsoft and expecting to get quarterly dividends. This is the power of the covered call. What if I told you that you could increase the percentage returns potential to be higher than 5.21%? Drum rolls. Enter the world of LEAPS. As you can see here, LEAPS is an acronym that stands for Long-Term Equity Anticipation Securities. That's big jargon for an options contract that has an expiry date in the range of 1 year or more away. So if we head back to tastytrade, a LEAP option would be an option that we could execute, say, about 312 days away. So if you remember, instead of buying 100 units of Microsoft at $24,000 because of getting assigned on the put option that you sold, or indeed buying Microsoft at $252, which is the trading price right now, you could go into the future and say, go into the options chain for the 19th of January 2024, which is 312 days away from today, the 13th of March 2023. And you could decide that you want to enter into the LEAP contract for Microsoft at the 215 strike price. So in simple terms, what you will be doing here is you would be buying the 215 strike price call option that expires on the 19th of January 2024. And as you will see, the collateral needed is not $24,000, but $5,630. Now, off the back of buying this contract, you can then go and sell the April 6th contract that we talked about for $245 and receive your premium. So instead of having to put up $24,000, you are now putting up just over $5,000, and you're still going to get the same $1,250 or thereabouts in premium for selling this call contract. Cool. Let's update our calculation now. If you remember, we said that you stood the chance of making a 5.21% return for selling the covered call on ownership of 100 units of shares that was purchased at $240 per share, which translates into a collateral of $24,000. Remember also that we mentioned that for buying the $215 call that expires in about a year's time, you would be putting up a collateral of about $5,600, and you could still go ahead and sell that covered call that would give you the premium of $1,250. And what that means is that your return on investment on the $5,600, when you compare the $1,250 premium that you receive, goes from 5.21% for the same period to 22.32% for the same period. That is the beauty of the leap, and this strategy is called the poor man's covered call. So in simple terms, the poor man's covered call is when you combine selling a call on top of buying a leap call that expires sometime in the future, compared to just the basic covered call of buying the underlying asset and selling a covered call on top of the underlying asset that you have bought. That's powerful, isn't it? But I'm sure you're beginning to feel like a Wall Street hedge fund millionaire right now. Those of you who have the inner risk averse persona will be asking, what's the catch? This is where we go into our bonus section. So what could go wrong with executing a poor man's covered call? So let's say you sold the Microsoft $245 call, and maybe at that time Microsoft was trading below the $245 mark. A potential outcome is that Microsoft's share price could rise above the $245 mark. Because you do not have the underlying assets to sell, you do not own 100 units, you've just got the covered call, you potentially could be forced to buy back the call contract that you sold at a loss, and that means that you would not be making any money. So that's one thing that could happen. So to mitigate this risk, what you want to do is to sell a covered call at a price that is potentially higher than the trading price of Microsoft and reduces the risk of being assigned. This means that your premium income would be a lot less, but at least you're not exposing yourself to the potential to lose money as a result of the value of Microsoft shares going up. So as long as Microsoft shares is trading below your strike price, you should be good. If you compare that with the selling of a basic covered call, what could happen if the price of Microsoft goes above your strike price? You will simply just be forced to sell it at that strike price, and you would not lose any money. So the risk reward ratio is higher here. So if you're content with just buying your shares and you have enough money to pay for 100 units of shares, and you're content with a reasonable ROI of 5.21% in less than a month, then you can avoid taking the risk associated with a higher reward and just be okay with your basic covered call. You don't need to go into getting into the poor man's covered call. So there we go. We've talked about buying shares at market value, putting in a limit order purchase. We've talked about selling cash secured puts. We've talked about the covered calls and the poor man covered calls. I hope each one of these explanations have made sense to you. If you've got questions, please leave them in the comment section below. And as always, if you haven't done so already, do not forget to hit the like and subscribe button and the notification bell. And if you know someone who will benefit from watching this video or other videos on the channel, please do us a favor and share on your social feed. We look forward to seeing you on the next episode. Take care.